Welcome. I told you I was about to do right. Welcome, everybody, to a very special edition of the Not Your Average Investor Show. We are talking today about the age-old adage that we like to always quote Warren Buffett on of being fearful when people are greedy, but more importantly, being greedy when people are fearful. And the fact that right now we're in this moment of fear. There's an opportunity to make intelligent decisions that are going to set you up for a bright future. And we're going to connect the dots on exactly how to do that. I am your host, Pablo Gonzalez. With me, as always, the guy that I affectionately like to call GC, because he's got the genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And our guest of honor today, the expert in the playbook on taking advantage of this opportunity today. He is do you call yourself the president of Patriot Home Funding? The president of Patriot Home Funding. He's the co-founder. He's not just a mortgage broker, folks. He's a business owner that can do really, really interesting things. Also highly educated, works closely with real estate investors, my personal mortgage provider, and also a strategic partner to JWB in many deals, because there isn't a lot of people that understand this space from your perspective the way that they do. John Seybert, welcome to the show, my friend.
Thanks, Pablo.
Yeah.
Thanks, Greg.
Wonderful to have you, buddy.
Absolutely.
Yeah. Good to have you on. And we want to welcome you if you are joining us because John invited you. We're pumped that you're here. We're doing this as a special edition of a live podcast that we do in this studio every single Tuesday, 12:30 to 1:30. You can also find it on podcasts. You can also find it on YouTube. It's called the Not Your Average Investor Show. So if you want to get really educated on rental property investing, on different ways to save for retirement that are more effective than the average results that Americans are getting these days, or if you just want a really deep edge into the Jacksonville real estate economy, this is a place to be. And it is also a great place to meet other great investors and not your average investor themselves, which we always welcome as a tradition on our show called what, GC?
The roll call, baby.
The roll call, baby. We got our community manager kicking us off today, Joanna, in the house. If you need anything from her, just chat away. We got the ringmaster in the house.
Drew Barnhill.
Drew Barnhill, regular on the show. We got Reggie Fonse from the Inland Empire, another regular on our show. We got the Gran Amigo, GC.
Bill Shields, desde Duval.
With a buenas tardes desde Duval. Good to have you, Bill Shields, in the house. I love you all coming here. You know, like we take the community very seriously, and everybody that shows up for us. This is a special webinar for new friends and old friends as well. But let's talk about the subject du jour. That means the subject of the day, John, in French, Reggie knows. And it's this idea of when we're talking about being greedy, when people are fearful, we're not actually talking about being greedy. We're talking about being smart. And you know, it's kind of an uncommon practice. What's going on right now is we have had this like historic run of real estate appreciation where investors have done very well. It's also coincided with a period of low interest rates, right? Which provide a great circumstance. And then for the last year and a half, we've been in this period of very high interest rates, uncommon for the last 17 years or so, which has scared people off. But as we have discussed over and over again on the show, our community is well versed in this based on the actions that they've been taking, is the idea that while most people, the average investor, is sitting on the sidelines with the rest of this pent-up demand thinking, you know, I want to wait till mortgage rates drop because then I'm going to get better cash flow. I want to have this better interest rate. What we've been telling folks is that if you look at historical trends, when rates drop, there is this bump in home price appreciation. And if you can buy ahead of the drop, then you can lock in this lower price. You can lock in this inherent appreciation that's going to happen. And then all you got to do afterwards is refinance and go back down to that lower rate, and you're going to be much better off. So we're going to explain all that stuff in greater detail. But for one, John, you know, you are well versed in this real estate space. You're dealing with real estate investors and retail buyers alike all the time. What is, from your perspective, what's the climate on this like high interest rate environment? Are people aware of this thing that we're about to talk about? Are you having these conversations?
The conversation comes up with most every investor that I talk to.
Yeah.
And I like to use an acronym called ACES, ACES, coined by my business partner, Pierce Outlaw, and co-founder. ACES, accumulation, cash flow, equity, and shelter, tax shelter.
Okay.
So these are four crucial characteristics, ingredients for the investor to consider when getting into buying rental property. I think we're in a unique situation now with the 10-year treasury dropping below 4% this morning.
Yeah.
And the Fed talking about dropping rates September,
In
possibly.
September, right? Hinting.
Which
Yeah.
it's already happening. So it's when people see that happen in September, if it does, it's baked into the rate right now. So they're ahead of the game. The markets are figuring that out already and going, okay, let's start playing this game now and dropping the 10-year treasury, and rates are dropping, as you guys are noticing with the people that we're working with on a daily basis. So, talking about, I want to touch on the appreciation piece that you talked about.
Please.
I've been working with you guys for 14 years, I think now.
Yeah.
And the years that rates went down to the 3.5 range, 2.5, 2.75, 3.5 range a couple of years ago, I had more people from JWB clientele from 2017 and 18 call me up to talk about refinancing
Right.
their rental properties. And I said, well, let's look at it. So I pull up their file. They bought a house for $145,000 in 2017. And I have a valuation tool in my computer where I can plug in the address and find out, give an idea what the value is today.
Right.
And they were surprised that, $145,000 house in 17 is now worth $250,000.
Right.
And so many of them came back, and a matter of fact, I mass marketed them. After I saw that, I go, wait a minute, there's an opportunity for them, obviously selfishly for me.
Sure.
So we probably did in that year, probably 60 or 70 cash out refinances. And these folks would take out their equity and turn around, buy more at a price that was probably in 2021 at 190, 220, that are probably now worth 250, 260. Right. So the appreciation piece is not stopping here in Jacksonville. I've seen it. I've lived it. So I know it's going to continue. And with rates going down, we're in a perfect storm situation here. The prices are holding steady. Rates come down. The buying power increases. Cash flow gets better. It's a win-win for all parties.
Love it. GC, that's a new acronym, ACEs. Right?
I wrote it down.
I thought you write it down.
I love it.
Yeah.
And we didn't even mention his business partner's last name is Outlaw.
Outlaw.
So when I hear that somebody with the last name of Outlaw tells me something about ACEs, I'm following that. That's all. That's why I wrote that one down.
Yeah. So we're pretty used to the 5 profit centers here of rental property investing, right? Like we explain it as home price appreciation, cash flow, tax savings, debt pay down, and inflation hedging. I've never heard of accumulation. What is accumulation? The AA and ACEs.
Accumulating property.
Okay. Oh, okay.
Accumulating property. And then that's where I came in with the appreciation piece and refinancing, cash out refinancing, accumulate more. Yeah.
Got it. The real estate portfolio that you guys like to help people build.
Absolutely.
Right.
Yeah, got it. Okay, cool. Well, then let's get into it, right? The way if I was to break it down back in this ACEs side of it, this idea of high mortgage rates where it's affecting the C, right? It's affecting the cash flow when people are buying right now. GC, for anybody who is obviously not your average investor show community members, GC well. If you are here, you're a friend of John's that he invited to the show. Gregg and his company, JWB, are I'm just going to say it, I have a huge man crush on Gregg and like everything that they've accomplished, but basically they have proven themselves to be one of the best in the world at bringing forth cash flowing rental income properties for people that aren't everyday real estate investors like myself. I'm an entrepreneur. I'm a really busy person. There's no way that I'm going to get into the real estate investing game unless it can be completely passive. And what I've been able to do is acquire a portfolio of 5 homes where Gregg and his companies has just brought them to me already built, already renovated, already rented out, already cash flowing. They manage any kind of like future tenant things and residents and maintenance and all that stuff, and have a portfolio manager that helps me with the A and ACEs, the accumulation to meet my financial plan with all that stuff. And they've done that all by something that we call vertical integration. They do that all in-house, all one team, 120 people, been written about on the front page of the Wall Street Journal a couple of times. Anyways, what I'm saying is you can trust this guy. He's not just a pretty face. Gregg, can you explain the actual thing that we are discussing here? Why is the reason that we tell our community, don't be average. Don't just wait for interest rates to drop. The time to buy is now.
I think as an investor community, really for the last year, maybe longer, there's been an overwhelming sense of fear, and there's been a lot of things to be fearful about. There's political unrest, right? This year, it's the election. We don't know how that's going to go down. But interest rates have really caused a lot of fear in the minds of investors for a while now. And we understand because interest rates rose at the fastest rate in over 40 years. And the investor community is like, okay, what do I do about this now? Where do I put my money? But what the average investor does in a period of time when there's fear in the system is they tend to do nothing. Fear leads to inactivity. But what we talk a lot about with our clients at JWB, and we talk a lot about it here on the show, is that there is an opportunity to have data and perspective that gives you confidence to take action, even in periods of time where you may be fearful or the common investor may be fearful because of the headlines. So bringing this all back to interest rates, there's a lot of insight and data to share here about what investors do, what smart, savvy investors actually do in periods of time where there are high interest rates. But just like John said, the Fed is signaling that they're coming down. This is a special, unique opportunity for you as an investor to take advantage and use a not your average investor perspective to take advantage of the situation and set yourself up financially. And here's what I mean. Most average investors think about it when interest rates are high, and this is probably the headlines that you guys are reading out there too. Interest rates are high. Investing in real estate is the wrong thing to do right now. Who in their right mind would invest in real estate when interest rates are high? But what we have to understand is the relationships between interest rates and demand for housing. And when interest rates go down, John, what happens for demand of housing?
It goes up.
It goes up. Mortgage application rates go up almost instantly. This leads to more buying demand. And if you hold supply constant and you increase demand, what that does is it increases prices. And so what we've done a lot on the show is to match this data with this perspective and help people take advantage of it and start to buy right now. Because I've been investing for 18 years now in Jacksonville single family rental properties, right? It has been my bread and butter. But over the last 18 years, there hasn't been a unique opportunity where interest rates are high and the Fed has said they're coming down. This is the first time that most investors are ever in this spot. And most investors are just flat out getting it wrong. They're going to sit on the sidelines. They're going to wait until the headlines say this is the time to buy because interest rates are low. And by that time, prices will have already risen and they would have missed out on tens of thousands of dollars of opportunity they could have had in their pocket. The ACEs approach here could be started today for folks buying while interest rates are high. And then what I hope we can get into today, since we have John here, is to talk through the mechanics of refinancing later on after you have taken advantage and have increased your wealth through this equity accumulation.
I love it, man. John, you mentioned perfect storm a little while ago. Is this what you mean by the perfect storm thing? Can you go a little deeper into what you're saying?
It is. Right now, the Fed controls PPI and CPI, Producer Price Index Report, and Consumer Price Index Report. And the CPI is made up, 30% of the CPI number is made up from rent. Okay. And you have owner's equivalent rent, OER. Okay. Owner's equivalent rent is a number that the Fed thinks what the rent should be. And the rents received are actually lower than that number. They haven't caught up yet. So rents are going to go up and they're going to catch up to that OER number that the Fed uses. And that's going to take a while. So as an investor, you know that rents are going to go up and you guys see it in your contracts. I see it now where you rent these places out for 2 and 3 years at a time. And year one's X, year two is X, and year three X plus. So you are ahead of the game because you see that happening. You know, you're going to meet that OER number. It's going to take on it. That's why the inflation's gone from 9 to 3%. And to get to 2%, this is what they call the sticky mile. And until that number gets the OER number, the rent received gets up to that number, you're not going to get to 2%. And it's going to take a while. So that's where prices are going to stay steady, probably increase a little bit, and rates are coming down. So the perfect storm, as Gregg said, is now.
So we're in the sticky mile right now.
Sticky mile.
Yeah, I absolutely agree as far as how hard it's going to be to go from 3% to 2% inflation, which is the mandate for the Fed. And the other thing to take from what the Fed is saying, what Jerome Powell is saying, is we are prepared to lower interest rates, meaning we are prepared to lower the Fed funds rate, which has an indirect relationship on interest rates. he's prepared to do that before we get to 2%. So while it is going to be sticky, it's going to be some time before, as an economy, we get to that 2% mandate for what the inflation reading is. The Fed has already said, we're not going to wait until we get there to start lowering our rates.
Right.
And that's really important, because that's why I applaud all of you for being here today, because this information is actionable today. When the Fed signals something like they are doing, just like John just said, it already starts to get baked into interest rates throughout the economy. It's not when the Fed does it, it's when the Fed says they are going to do it.
Right.
And so that's why within our investor community here at JWB, we've gotten really loud about this over the last month or two, because this is that unique opportunity. And the longer you wait, the less of an opportunity you have, because again, you know, interest rates going down will have a sizable effect on investor demand, buying demand, and prices going up.
GC, you've done a little bit of, if I'm recalling recent shows, you've done some research on this idea of like the average amount of increase. Can you put some stats around like what historically has happened?
Absolutely. So I went back to the data and I went and I looked at times when interest rates dropped more than 1% in a calendar year. And I went and I looked at what did home price appreciation do in the following 12 months after that. And guess what? Home price appreciation on average was over 5% in the following year after interest rates dropped at least 1%. And it happened 5 out of 6 times. It's only happened 6 times since the data was presented. I think it was the last 60 years is how far this goes back. So it doesn't happen all that often. But 5 out of the 6 times, home values went up substantially. The one time it didn't happen was the Great Recession. Okay. The one time it happened that home values did not go up was the Great Recession. But we all have to understand the Great Recession was an anomaly. It is not typically how things work. So 5 out of 6 times, this has shown that interest rates going down lead to higher than average home price appreciation in the following 12 months. And that's our thesis here.
There you go. So not only is the sky not falling, but we are looking forward to a period of prosperity for anybody that's in this asset class ahead of time. And that's kind of contrary to what people believe. I know that we do a quarterly investor call here on the Not Your Average Invest Show. We got it coming up in a couple of weeks. It's our most attended show. And we're always kind of like painting what it looks like today, what the headlines are saying, and what we think is actually going to happen. And we've been preparing for that hard. So like anybody that's new to here, and if you can't make it every Tuesday, in a couple of weeks on Tuesday, I promise you, you won't be disappointed when Gregg shows this thing. But to that point, if you read the headlines around real estate, around reduced demand, around reduced transactions, you think the sky is falling around real estate. And you need this idea of data plus perspective. You need not just people that can look at, you know, today's snapshot, but 2 folks like the 2 of you who've been doing this for 15, 17, 18 years. How long have you been doing? 40 years. I'm sorry. You're the statesman around here. Gregg's only been doing it 17 years. I've only been doing it 5. But that being said, right, that's why we talk about data plus perspective. So at the end of the day, the key thing here to understand is there's an opportunity to be made. And then, you know, if you can be comfortable with the process and the product of how to do it, easy peasy, right? So that's why John's here. John,
let me add something to what Gregg was saying about the 5 out of 6 times.
Mm-hmm.
I say it's 5 out of 5 because at one time in 2008, when prices did go down, that was an anomaly. That will never happen again. And that was all because of one loan product that was on the market.
Mm-hmm.
And we sold it because that's what the investors gave us.
Mm-hmm.
When an investor was buying houses with 0 money out of pocket, with no income documentation, so 100% financing, no income documentation, and a 620 credit score, easy to walk away.
They were called ninja loans back in the day, right?
Yeah, no income, no income, no asset. So these guys would buy a house. I had guys buying a whole street. They buy a whole block for $120,000 per house.
Right.
Flip it for 150. 6 months later, that guy flips it. And the third guy is the one guy holding the bag. The music stopped. There was no chair to sit down in, and that's when everything crashed.
Yeah.
Just because of the loan product, it had nothing else to do with it. Nobody had any skin in the game, so it's easy to walk away. That's not happening again.
we talk about it, real estate and the lending environment really caused the Great Recession.
Yep.
That caused that recession. And that's why real estate took the brunt of that recession. Every other recession that we're talking about, real estate didn't cause those other recessions.
Right.
And real estate did quite well, even though the economy was in a recession. So that's a really good point to point out. In reality, the way that you and I both look at this is in normal times when interest rates go down, home prices go up.
Yep.
And it's not even a question.
Yep.
Love it. So let's talk about that process, right? Like when I hear cash out refi, these days, as the host of this show, I've become a little bit more familiar with it, but I've never been through it, right? So like, it sounds daunting. It sounds like a tough thing to do. It may even sound expensive, right? So
It's no different than getting out a loan for a purchase.
okay,
It really is.
Yeah.
It's all about the equity in your house.
talk us through it. Talk us through it. How does it go?
So, you come to me, for example, people I worked with in 2017 and 18 bought a house for 120, value's now 250. Make application, do an appraisal on the property, try to keep the loan to value around 75%. That's the sweet spot for interest rates. If we can go lower than that, even better. And they pull their cash out. It's no different than doing a purchase loan. So it's the same thing, same documentation, nothing different.
Got it.
Simple.
Yeah.
Really simple. Personally, I've used it. I bought a house in one of my rental properties. I have a couple. I bought one in 2002, I think it was, for 160,000. And it's a rental property for all that time. I never lived there. And in 2015, when I moved my corporate office from a rental that I was renting to buying a building, I looked at that house. I'm like, yeah, that thing's worth 300,000. I only owe 120. Did a cash out refinance, pulled out $80,000 and bought the office building I'm sitting in now. So use that equity to leverage it to buy something else. No brainer.
Yeah.
So that's what I encourage people to look at their portfolios and give us a call. We've got valuation tools. We can tell you what we think it's worth, and these tools are pretty accurate. So do that quite often.
I mean, we see people in our community doing it all the time, right? Like I think the first time I noticed it, I was like, wait a minute. So you're telling me that these investments have their own investment babies, right?
Yeah.
Because it's no more real like cash out of your pocket, right? Like you're not what you were describing is essentially buying a property that, I don't know, 5-10 years later, all of a sudden with the same amount that you had put into that original property and a little bit of process, you now have 3 properties.
Exactly.
And I remember the first guy that kind of like brought it to light in our community.
It's the accumulation piece.
It's the A in ACEs.
That's right.
Yeah. It's the accumulation piece, right? There you go. Lee Bishop, our MVP of the community, says it. Hervé Francois. We call it the Hervé because he brought that to light. And it's one of those things that as a new real estate investor, like I have been, I feel like I can't call myself a new real estate investor. I really think I'm legit now that I have 5 properties, right? But like I remember being a new real estate investor and talking to new real estate investors. It's you talk about, the ROI of a property and like these deals and like what you're putting your money into. It's really hard to quantify the idea that in real estate, it gets better with time. And part of that getting better with time that'll never show up on a deal sheet is the idea that at some point in time, your one property is going to turn into 2-3 properties. And it's really good, man. GC, what is your experience with that stuff, man?
So we are so blessed to serve over 1,600 clients. And after doing this for 18 years, we report on all the success that our clients have had. This is available for every client. You get your client ROI report at JWB, and you get to see for all 5 of these profit centers, just how much wealth has been accumulated. So what we know is that 2 JWB clients have made over $2 million just in their JWB investments.
Wow.
Right? We have over 160 JWB clients that have made over $500,000 just in these investments. And a lot of them do what you did with your investment property, where they're like, they look at the report one of these days, and after not looking at it for a few years, and they're like, holy cow, I got like 150 grand equity right here, right?
Put it to work.
So that's what I love so much about this asset class. But, the takeaway as I'm listening to both of you is many people don't realize that this asset class is so flexible. It's so beautiful because we have such strong lending partners and because our country is built on lending to real estate. We have these incredible options here in the United States that you just don't get when you go to other countries. that you can start with a portfolio of 1.
Mm-hmm.
And within a few years, you can build it up to 5, just like we've all witnessed you do.
Yeah.
Right. And your next progression is going to be like Irving.
Babies, baby.
Right. So, when we talk about how do you build a better retirement account through rental property investing, and we say, oh, well, your goals might dictate that you need 5 rental properties or 10 or 15. Many people are like, how can I possibly get the money to invest and put a down payment on 10 houses? How is that even possible? And they start to create excuses as to why they'll never be Pablo, or they'll never be John, or they'll never be Lee Bishop, or any of our friends in the community here. But in reality, the successful investors who are a part of this, if you're a part of a team that can walk you through this, what happens is you get started with 1.
Yep.
You get to that 3 level. And then after a few years, you go and you talk to John. We set you up on a phone call with John. We say, listen, let's talk about doing a cash out refinance. And all of a sudden, now you're at 5 properties. And maybe a year or 2 later, we do the same thing. And we look at it and, maybe now you're up to 7. And so it builds on itself because of the beautiful financing that we have in this country and because of the partners that we have. And that's really how you can become one of those $2 million clients for JWB over the next 10 years, right? And that's how you build a better retirement account. So these are just real world examples. And, and the beautiful thing about this is you've got all of this success and experience in this room for you. And it makes this really daunting process of like, how am I going to build for retirement, or how am I going to invest in real estate, or how am I going to build a portfolio? And it becomes easy, it becomes accessible. And that's what drives me, is making this asset class easy and accessible for everyday people.
Yeah. Speaking of great experience in the room, thanks to our community showing up to this webinar, Leslie Wilson's putting in the chat here. We call her the maven from the mountains of Colorado.
Yes, she is.
She's saying often that accumulated equity is called debt equity, right? Like that equity that you build in your house is called debt equity because it's not working for you, earning more money. This is why it's good practice not to let it build up too high, as your house will appreciate the same whether or not you have a mortgage on it or not. Right. So not just in this room, in the chat room right now, if you are a friend of John's that's like curious about this stuff, there's a ton of like inherent knowledge of people that have been doing this for a long time and really know what they're doing.
And just in that statement there is so much insight and knowledge just in that statement right there. We probably won't have enough time to go into depth on that. But if you want to talk to somebody who's super successful and understands the power of leveraging real estate responsibly to accomplish your goals, talk to the maven there, talk to Leslie, because that right there is gold.
Speaking of leveraging it responsibly, right now we're talking about cash out refis as like the move to buy now at a low price, lock in that appreciation, that equity that's going to grow when the rates come down, and then be able to have the low interest rate, increase cash flow, right? The C and ACEs as it goes on. I've had, before we get into the actual product itself, John, because I know you're excited to talk about it. Sounds really, I like when you guys started nerding out about it before the show, I was like, oh, okay, I need to catch up to this. Anything as far as if you're, this idea of cash out refinancing to pull out cash out of your home, sometimes people look down about that, right? Do you see any kind of like do's and don'ts of like how to think about that?
Absolutely. Leverage or using debt is a tool. It can be used for a ton of good, or it can be used for a ton of bad. That's why you need to surround yourself with people who are experts in their field, like John and like JWB, to make sure you do it responsibly. But here's the thing. It's not that hard to follow time-tested, proven strategies to do it responsibly. And I always equate it to how banks make decisions, okay? When a bank provides you a loan and they say you need to put 20% down for your house, what the bank is also saying is, I'm willing to lend out 80%, right? I'm willing to take the leverage on this up to 80%. And so what John talked about before is, taking leverage out somewhere around 75% on a cash out refinance is a good rule of thumb. I don't even know if products even go higher.
You can go higher.
You can.
Good.
Okay.
Good.
So the first thing to look at is, what is the loan to value, right? I don't even think I'm unaware of this, but there certainly aren't as many products for you to go anywhere close to 100% loan to value like there used to be back in the day.
There's one.
There's one. Okay.
If you're a veteran.
If you're a veteran.
Right.
So, the key to look at there and to do it responsibly starts with loan to value, in my opinion. Somewhere around 75%, 80% is what the banks already do.
Right.
And so that's a conservative note there. I mean, what would you add there?
I agree.
right?
Nothing else. Yeah. Simple.
Yeah, got it. So 80%. I guess the question I was saying
Can I
is like,
explain what 80% is? Like,
yeah. Well, the question that I was asking is like, what I was trying to get you to say is don't go out and buy a television or a car with his money.
gotcha. What do you do with that next?
Yeah.
Don't go to Vegas.
Yeah. Don't go to Vegas with it. In the classes that I teach on behalf of the Not Your Average Investor Show inside other communities, this idea of, for it to really understand if this is the first time being exposed to it, yes, that is ghost equity. You can use that money for whatever you want when you cash out refi. The key is, and the reason why so many people have had so much success, we have these millionaires that have been made within our community, is that if you can take out money at 5% and invest it in 10%, then you're making money on that money, right? So like, it doesn't have to be those numbers, but as long as you are making a better return on money that you are borrowing at a certain cost, it's what we call financial engineering. And that is how to use debt intelligently. Don't use debt to like buy stuff that isn't going to pay off later on. Is where I was trying to go.
And keep in mind, these are long-term holds.
Correct.
This is not something that's going to happen in 3 years.
Mhm.
This is a long-term hold, and you've got somebody else paying your mortgage payment for you. I mean, that's the way I looked at it when I started investing probably 25 years ago. I just thought of it, okay, cash flow wasn't that important to me at the time.
Sure.
Made a good living, so I didn't have to worry about that. I wanted to be neutral. I don't want to have to write a check every month.
Yeah.
But as long as I had somebody else making that payment for me, and over time, as I said earlier, that house went from 160 to 300. Use the equity, buy something else.
Yep.
The building I bought 200 is now worth 400. So, all these things just multiply.
It became very apparent to me early on. I started to invest at age 23, and I was not investing for cash flow to change my life at that time. I
Right.
didn't need much. I didn't have a wife and kids at that time, right? Like an additional $100 or $200 a month in cash flow
make a
didn't mean anything to me. I was investing in building my business at that point anyway, so I wasn't even spending money. But what I wanted to do was to build an army of income producing assets, because I knew at some point down the line, whether that is 10 years, 15 years, 20 years down the line, when I hopefully had a wife and kids, as I'm blessed to have now, that I would have options of what I needed to do with, or what I could do with my time. So this goal for all of us, no matter what age group you're in right now, don't invest to change your life tomorrow, right? That's the trap that we fall into as Americans. Invest, build up assets that you have that grow for all 5 profit centers like you're talking about. And then over time, you will control your time. You will control your activities, and you'll have options. But it doesn't start unless you accumulate those assets. That's why I love ACEs so much. The first is accumulation, and that's where the real wealth becomes apparent.
Yeah.
Yeah. And by the way, if you want to take that step, right, like the obvious first step is to go to chatwithjwb.com, and you can schedule a time there and talk to Gregg's team. They'll work with John as well and guide you through the whole process, make it totally passive. If you just want to shoot an email, go to info@jwbcompanies.com, and you can get started on that process. But that's the main thing, is just like get that conversation started right now and have one of the experts here at JWB start kind of guiding you through that process, because it takes a little while for you to get comfortable with it, and JWB to make sure that they're putting you in the right place. John, I know that you love talking about the product and what it looks like right now.
Mhm.
Tell me about it, man.
So the product we're talking about is a debt service product.
Mhm.
DSCR,
Mhm.
debt service coverage ratio. Great product. I was telling you, Gregg, earlier this morning, that the difference in price between a Fannie Mae, conventional Fannie Mae loan, which is the normal avenue that people use, compared to the debt service product, it's like $120 difference. So it's $120 more to use a debt service product than it is Fannie Mae. So not a lot.
120 one time
$120
Okay.
cost, yeah, one time.
total.
Yeah. But here's the difference. The debt service loan product, I don't ask for tax returns. I don't ask for pay stubs.
Mm.
I don't care if you have a job or not. We don't even list a job on the loan application. Okay. It's all about assets. What do you have for the down payment piece? Your credit and the property itself that you're purchasing. So those 3 characteristics are really what drive the debt service ratio. I'd like to see it at 1% or higher. That's the best bucket. Actually, the best bucket is 1.35 or higher.
Mhm.
Bucket in interest rate
Mhm.
is the best spot to be. So what I mean by the ratio is, let's assume that your payment, your PITI, principal, interest, taxes, and insurance, let's assume that's $1,000 a month. We want the rent to be at least 1,000. Meet that 1-to-1 ratio, 1% ratio.
Got it.
If the rent is 1,500, you're going to fall in the bucket of 1.35 or higher,
Mhm.
which means your interest rate gets a little bit better. It's not exponentially better, but it is better.
Yep.
So it's about 30 basis points in cost difference.
And over time, that's a lot of money.
It adds up.
Yeah.
So the product's a great product. It's what we call a non-QM product. So it's a non-agency product, agency being Fannie Mae, Freddie Mac.
Mhm.
So these are investors. I think the investors that we work with, large institutional banks, Credit Suisse, people like that. And it's just a great product. It's easier for the consumer. My processor, Harley Anderson, will say it's harder for him
Yeah.
because they scrutinize everything else because there's nothing else to scrutinize.
Yeah.
There's no tax return or pay stub to look at. So they dig everywhere else. But for the consumer, and in my opinion, it's an easier product and easier to get through.
Let me just give a little bit of perspective on this, because debt service coverage ratio products still, we'll call it still relatively new. They haven't been around for decades and
No,
decades.
couple of
right?
years.
Right.
Yeah.
So it's still relatively new. But there, in all my experience, I have never seen the DSCR product have rates and terms that are almost identical to Fannie Mae products. I have never seen it. I flat out don't even understand why the rates are so low. There's a back-end investor somewhere out there who is having demand for this. And so I don't, this is like a special opportunity for a DSCR product. And I don't know how long it's going to last. I hope rates come down all the time. But what I would expect is Fannie Mae rates to go back to being much lower and better terms than DSCR.
Well, you're right. I can tell you this, the DSCR product has gotten closer over the last 2 months.
Yeah.
There was a delta of about a point.
Yeah. For a long time.
So
right?
why it got down there, I don't know. Obviously,
I don't know.
They're making money or they wouldn't be doing it.
Yeah.
So,
well, I think, but then the other thing that I wanted to point out is, we talked about what led to the Great Recession.
Mm-hmm.
And we talked about how lending products that didn't require tax returns and other things was a major driver of the Great Recession. That's not what this product is.
no.
What the back-end investors have realized is that lending on cash flowing rental properties is really good business, because what the DSCR is, the debt service coverage ratio, like John said,
Mm-hmm.
basically, if the income from the property covers the expense, the debt on the property, then you have a cash flowing property and it's a good bet, right?
Yeah.
It is a sound business model.
Right.
So I wanted to make sure that we pointed that out, that this is a relatively new product, but it makes core foundational fundamental sense. And I hope that it continues to go down this. I hope there continues to be more back-end investor demand as it gets closer and closer to Fannie, because for years now, we have used DSCR products internally at JWB for the assets we buy, which we own over 300 properties in our own neighborhoods, and same neighborhoods we would put you as a client in. But those rates have been higher for us than what we could have potentially had for Fannie Mae.
Let me add to that, Greg. We have an annual trade show, FAMP, Florida Association of Mortgage Professionals, and it's this Friday in Orlando.
Mm-hmm.
And I was looking at the roster of companies that are going to be exhibiting, and there was probably 60, 70 different companies, mortgage wholesale companies, people that want business from mortgage brokers like myself. And I didn't recognize half of them. I've been doing this for 40 years, and I'm like, who are these people? So I started doing some research on some of these names, all non-QM lenders. So they're all getting in the game.
So
now.
you see it more.
So more of them in the
demand.
game, the rates are going to drop. I mean, they're going to
Think
compete.
about it, because this back-end investor money is looking for safe places to put their money.
Absolutely.
And investing in U.S. real estate and in mortgages is a pretty good bet. People have been doing it for decades and decades and decades.
They're not making any more of it.
They're not making any more of it. So I did want to recognize that this is a unique opportunity there. And then just talking about the ease of use of a DSCR product over a typical Fannie Mae product, listen, the lending process is not fun, and it's certainly not fun even if you go through the DSCR product, but it's a lot and more enjoyable than your typical Fannie Mae stuff.
Two other facets that you need to understand with this product, which Fannie Mae doesn't do. Number one, you can have more than 10 finance properties. You can go up to 20. And sometimes you can exceed 20 with an exception. I've done that before. The other thing is they let you close in an LLC.
Very nice.
And Fannie Mae won't let you do that. So most investors that we work with have LLCs. set up.
Mhm.
They have their limited liability corporation set up, and they like to place it in there for liability purposes.
Mhm.
And Fannie Mae doesn't let you do that. So
Mhm.
that might change someday. I hope not, but yeah.
And why don't you tell them the interest rates that you're able to get with the incentives that JWB is
So
offering?
we'll go back to yesterday because things changed this morning with the 10-year treasury going below 4%. So yesterday I priced out a loan. Let's assume, I think the purchase price was 252,017 or whatever. And the loan amount was 65% of that. So the person was putting 35% down. The 2% that you're offering is 2% of the purchase price, which in this case would be $5,000.
Mhm.
That $5,000 would get the borrower a rate of 5.625. If the borrower kicked in an additional, this is yesterday, an additional 1.7% of the loan amount,
Mhm.
they would get the 5.25.
Mhm.
Today, they kick in 1.44%.
So it's
That
getting
much,
much better.
that much movement in 24 hours.
Wow, that's a lot of movement.
Yeah. So I suspect that we'll be in the high fours here soon.
I hope you're right.
With these buy downs.
With these buy downs.
Right.
Explain that to the,
Yeah.
for asking for a friend, right? I obviously know what this is about.
So there's a whole lot of financial engineering that JWB and John's team do
Yeah.
before we present the portfolio for our JWB clients. So what John's talking about is the nitty gritty details that get you there. At the end of the day, what you're going to see on your pro formas for JWB is a 5.25% expectation of what your interest rate should be.
Right.
That's going to include some incentives on the JWB side. So we actually pay to buy down your rate a little bit. And then it also includes a buy down on the buyer side as well. But all of these costs are included in the pro forma. So just keep in mind, we're talking about roughly a 5.25% interest rate when it's all said and done today, right? So while the rest of the world is paying interest rates at 6.5%, 7%, right? You can make this decision to add to your portfolio today, work with John, and get a 5.25% interest rate, which what that equates to for your return on investment for your JWB rental property is somewhere around a 10% return.
Right.
So you're able to stack assets, you're able to follow ACEs here, accumulate, and get interest rates that you probably weren't expecting are available today because of working with JWB and John and the DSCR product. And you can start to accumulate now, and then think about what happens when the rest of the economy starts to work as interest rates come down for everybody else. And as home values go up because of that, well, now you locked in today at a really good interest rate, one that you were probably hoping you could get tomorrow. And then you've set yourself up to increase your accumulation of equity as home values go up over the following years.
You know, we changed the model. It was 25% down for the longest time. With rates at 6 and 6.5 and 7%, we had to change it to 35% down to get that cash flow neutral position. We're almost getting to the point where we can go back to 25% down.
That's cool.
We're
That'd be
close.
great.
We're
Yeah.
close. So if the rates come down just a little bit more, we can probably scale that back, get your cash flow neutral at least or positive.
Yeah. So if you're following at home like me, the two things that I heard in this last, I'm sure that there's more experienced people than I that were able to like really, really conceptualize those numbers. What I was able to conceptualize right now on all that clarification is twofold. One, we started this call talking about how there's so much pain in having high interest rates today that people are waiting, and you should buy today to refinance tomorrow. What I just heard from you guys is that even buying today, that pain is actually lower than most people expect, right? You're actually buying at a lower interest rate than you thought today based on these products. And two, when you said earlier that it's like, oh yeah, just like getting a regular loan. And I was like, oh man, getting a loan's a pain in the butt. It's actually easier than getting a regular loan because you're using this DSCR product. It's less about your personal, like income, I guess, and more about like the property itself that contains the value for the lender.
I find most investors, I shouldn't say most, a large percentage of them are self-employed.
Yeah, that's what I was thinking. I'm
Entrepreneur.
self-employed. Yeah.
And when they come to me, and first question I ask, what do you do for a living? What's your tax return say? Let me look at them. And most notably, they all say, I write everything off.
Mm-hmm.
Well, of course, you're supposed to.
Mm-hmm.
And that's where the DSCR comes in. I don't care.
Yeah.
I don't care how much money you make. I don't even put a job. I had a client yesterday who said, a former client of yours who's buying another one.
Mm-hmm.
And he said, how come I don't have to put a job on the application? I go, we don't care if you have a job.
Mm-hmm.
It doesn't matter. It's
Mm-hmm.
credit score, asset, in the property.
Mm-hmm.
So
Yeah.
it really is pretty simple.
Awesome.
And a lot of these people, these investors who Leslie Wilson with her right now.
Yeah.
Hi, Leslie.
Amazing.
You know, I said, I don't care how much your rental income you make. It doesn't matter.
Yeah.
I don't care.
That's great.
Yeah.
So cliff notes of the conversation. We got some great questions right now. We're going to dive into the Q&A side of it. Cliff notes of the conversation is essentially, as interest rates start to drop, which they are doing as we speak right now,
Right.
prices are going to go up. Therefore, the smart investor move isn't to wait till they drop further and lock in later cash flow. It's to lock in the low price today with lower rates than you expected were going to be. And then later on, after this price increase happens, you can refinance even further down with a simpler product that costs, you said, about $5,000 to do.
That
and
depends on the loan amount, but you
Yeah.
can factor in probably 2.5%.
Yeah, 2.5%. So a lower cost than most closing costs when you're buying a new property, and then you are locking in a higher cash flow after the fact. And if you are looking to do all that stuff, the logical next move is go to chatwithjwb.com. You can pick out a time to talk to the JWB team who will package all this together, make it really, really easy for you to acquire, work with John, and then own this thing for the long term, because the experience is what's going to keep you in there. So chatwithjwb.com or shoot an email to info@jwbcompanies.com. And GC, you had something to say here.
Well, I did want to talk about one cool thing here. Everything you just mentioned is 100% accurate, right? There is value to buying while interest rates are high, so you can lock in your purchase price at a low point, and you can refinance later, and you're going to make money on that trade, meaning the equity that will be gained by prices going up is going to be more than what you may have to spend as you refinance. But here's the other thing. With John's product that we're talking about here and getting in at maybe roughly a 5.25% interest rate, you may not need to refinance.
Yeah.
You may just get both benefits here of locking in a great interest rate today, locking it in as home prices go up over the following year because interest rates come down for everybody else. And when those interest rates come down, I don't know if they're ever going to get close, below 5.25 for most people.
You got to drop at least 1.5 to make it worth your while
Yeah.
to refinance. So if you're at 5.25, you're going to have to see 3.75.
Yeah.
Is that going to happen? Maybe. I don't know.
I don't know if it ever gets
know.
down there again. So bar none, it makes sense if you buy and then you refinance later on that trade. You're going to make money on that. But I think there's a really high likelihood that you might not decide to refinance later on. And this is just kind of a double win there.
Just a good buy today. All right, let's do a little rapid fire Q&A. The first one is from the MVP of our community. May have heard of him, Lee Bishop. He says, John, what's the credit score you're looking for to qualify for the loan? A lot of lenders I work with are looking for 700 or better.
680.
Okay.
680. And then loan to value will play a part in that too. The higher the loan to value, the higher the credit score. But we can do it 680.
Cool. That's rapid fire right there. Ringmaster Drew Barnhill is asking, since mortgage rates are based on the 10-year T-bond, can you explain why that spread above this rate changed for mortgage rates? For instance, rates go from anywhere from 1.5 to 2.5% above that T-bond rate. Anybody want to take that?
Yeah, I could take that.
Yeah.
So historically, that spread has been about 1.7%. What we're talking about is you look at the 10-year treasury, and then you look at what average interest rates are, there's about 1.7% of a spread there. And that's really how the mortgage market works. Investors look at investing in 10-year treasuries, or they look at putting their money into mortgage-backed securities. And over time, that's been about 1.7% more that they would require in a return to make that decision. But over the last few years, it's been a lot more than 1.7%. Because investor demand has not been as high for a number of reasons. So it's been up to 2% and 2.5%, and that has compounded the problem of high interest rates for all of us.
Mm-hmm.
So, but historically it's 1.7%. So again, coming back to how timely this information is today and how you should be able to take action on it today, when the Fed is signaling that interest rates are coming down, that creates more demand from back-end investors investing in mortgage-backed securities that in theory can shrink that spread down from 2.5% to 1.7%. I don't know if I'm losing anybody here. Ultimately, what this means is that interest rates for us can come down even if the Fed doesn't do anything. Right. And so historically, it's been 1.7%. If we could get back there, even if the Fed doesn't change anything, doesn't drop interest rates, our overall interest rates would come down. So there's a lot of potential good things coming down the pike is the way to wrap that one up.
Yeah, cool. Patriarch of the first family of the Not Your Average Investor Show, Ken Moline, is asking, is a cash out refi a total restructuring of your original mortgage, or can you take it out as a second mortgage?
Cash out refinance is a new mortgage, so you're paying off the current loan that you have. So depending on what your rate is currently, I mean, if you got a 3.5% rate, I wouldn't probably refinance unless you're pulling cash out to invest in another
To do
house.
something,
You know,
yeah.
you have to look at the numbers and see if it makes sense. But
Makes sense. So not a restructuring of your mortgage.
No,
it's a
it's-
new
it's a
mortgage that
brand
used
new
to pay
loan.
off the old mortgage and gives you a
Exactly.
new loan. All right, got it.
Yeah.
Mountain Man Billy Green says, John, does John and his company provide services for these relatively new home equity agreement loans? I'm intrigued by this service, but need to better understand potential costs.
Right. That's a HELOC
Okay.
acronym, home equity line of credit.
Okay.
We do them. We do them. To be totally honest, I think there's some banks out there in the community that do it better than we do.
Okay.
We're a mortgage broker, so we have different outlets, but I've seen some local banks in Orlando where we're located, Altamont Springs, get pretty competitive.
Cool.
Yeah.
Good reason to reach out to you and just kind of talk through
I
it.
had one last week where the gentleman came to me and he started talking to me about it. And I just told him what the rate was. He was fifth thirds at 6%. I'm like, on a home equity line? He goes, yeah. I go, take it.
Mhm.
Do it.
Cool.
So I wanted to ask one more question, because what the Mountain Man might be talking about are these loans that basically take a piece of the appreciation, the value gain over time, and I'm not so familiar with it. I was wondering if you had any insight into that.
No.
No?
It's a home equity loan?
Yeah. So yeah, the Mountain Man's talking about that. Yeah. So there's new loan products that are out there now that, basically they know that real estate goes up. They know ACEs. These lenders know ACEs. And what they're willing to do is to come down on their rates and terms, better rates and terms in the short run for the borrower. But what the borrower has to give up is long-term growth in the asset.
Oh, I wasn't aware of that.
Yeah. So it's something new out there. Mountain Man, I don't know a whole bunch about it. I don't know if any of our clients have actually used one of those products. To me, it kind of, you understand the value of holding long-term. So, and if the numbers worked where you can be cash flow positive and, benefit from all 5 profit centers, which is the only loans we're going to put you in here at JWB and with John, I think it's a lot to give up later on, especially in an environment where we expect interest rates to come down in the future. So that'd be my slightly uneducated take on it, but certainly worthwhile of more education on it, I would say.
Got it. Cool. Very interesting. So all the way from France, Anonymous Attendee is asking a question. With the debt service product, does it have a number of loans to one person limit? And is it available to LLCs? You answered this earlier, right?
Well, it's 20.
Yeah.
20 per
Okay.
person.
20 per person.
The LLC question, it's not lent to the LLC. You can title and vest the property in an LLC. The loan's in your personal name. You're responsible for it. It's your credit. You're making a payment. The LLC is not making a payment.
Makes sense.
Yeah.
Got it. Got it. And congratulations for the Olympics, Anonymous. Lee Bishop, MVP, will send us away here with his final question. The Fed did not drop the interest rates this time. John, how long does it really take from the Fed dropping the rate to it rolling out to the banks? I hear as long as 9 months for a bank to push the savings out to the customer. Is this correct?
To a bank, I don't know. To a mortgage company, it's already happened. So the fact that they didn't drop the rate at their last meeting, was it yesterday, the day before, whatever it was, it's what they said that makes everything in motion. So they made the comment that they're probably going to drop in September at the next Fed meeting. That's all that needed to be done. As you see, the 10-year Treasury, it was 4.1 yesterday, and today it's 3.98. So it's falling. And as I told you, the cost to the consumer is coming down. So it's all good.
We got to root for the Fed 10-year Treasury to go down, the yield on the 10-year Treasury to go down. That is a harbinger for what our long-term interest rates are going to do. And it's moving in a good direction for us.
Absolutely.
Love it. Love it. I love the picture of, it feels like a really complete picture of this opportunity, right? Like it is kind of like you said, it's the perfect storm of prices are going to go up. So get in now. Rates are dropping and you have flexibility with that later on. Also, right now, the rate's pretty attractive based on what's happening. And oh, by the way, limited time here, right? Because we're not waiting those 9 months for the Fed to drop, for then banks to pursue. It's as soon as the market starts believing it's going to happen. And it sure as hell is telling us that they're believing it's going to happen, right? So the opportunity right now to be greedy when people are fearful, people are not going to be fearful for very long. So the opportunity is to act now. Go to chatwithjwb.com, pick a time to talk to Gregg's team, work with John on this stuff, make it really, really easy like I and so many other folks that joined this call today have. If not, just shoot an email to info@jwbcompanies.com. Gentlemen, this was a pleasure. I really enjoyed this, man. Listen, I haven't said this yet today on the call, but my favorite story about John is that I recently picked up a duplex in January, and I was telling Gregg, hey, I'm picking this thing up. This is what they quoted me. He's like, I think you should talk to my buddy John. Got on the phone with John. Guy saved me 0.8% on my mortgage right off the bat. So I will forever, at least for the next 30 years, I'm going to speak your name, John. And I'm really, really grateful for that. I appreciate you driving all the way from Orlando to make the show, man. I really added to it.
The opportunity.
Yeah, thanks for being here, man.
I'll leave it at this. Your deal was a special deal.
Yeah.
Not just because of you.
You don't say that to everybody.
I'm in the end of my career. You know,
Uh-huh.
I've been doing it for 40 years. I'm 64 years old. And my attitude is I'm hitting singles, not home runs. You know, the guy who's closing 3 loans a month, he's got to hit a double and a home run or he's not going to be able to live.
Sure.
I'm hitting singles.
Mhm.
And the people that work with me at JWB know that because I'm very competitive. I think I'm as competitive as anybody, if not better. So that's my motto. It's singles.
Everything you do is focused on client success, you know,
Period.
and a lot of what you talk about with you hitting singles right there, right? Ultimately, what that does is number one, it sets everybody up for a better return on investment. But more importantly than that, it's the type of relationship that they get to have with you.
Right.
Pablo, and you have that relationship, but it starts with the JWB relationship because you've serviced, I don't know how many hundreds of our clients on loans.
More than probably
1,000, right?
Yeah.
When you're an investor, when you're a new investor and it's scary to get a loan, you don't want to just be treated as a number. And when you get to work with JWB and with John's team, you know, the strength, this partnership for over a decade now and thousands of loans is what hopefully makes you feel more secure about maybe your very first investor purchase. So we've appreciated it, man. It's been one of the best relationships that we've had is our special partnership with you, man.
Appreciate it. Thanks
and
for the
thank you.
opportunity.
Thanks for being here in the hot seat.
Yeah, John, these singles you're hitting are just putting people on base, man.
That's
And
right.
pushing them through. I feel lucky to know you. I really appreciate you coming. This was a great show. Really appreciate the community showing up. Thanks for promoting this. Thanks for bringing your friends to this thing. Thanks to our folks that show up on Tuesdays, every Tuesday. It's a big ask to get people to take an hour in the middle of their day. As you can tell, people do it, and it makes this a lot better because it adds a lot to the whole experience. And we like to end our show with one little piece of advice every single time. GC, what is that?
Don't be average.
See you on Tuesday.